So in this video, I'm going to walk us through the calculation of the various components, growth component, price recovery component, and productivity component that I talked about in the previous video. I'm using a problem that is in your textbook 12-22 to do this. So if you want to follow along with the data in that problem, you can. But I'll walk us through. What we've got here is Gianni and Sons. They are, they produce or don't produce, they purchase t-shirts and then use a trend-setting silkscreen design to enhance them and make them unique and then sell them to retailers. So in essence, what they are trying to do is follow a product differentiation strategy. And that means that they're going to rely on their innovation and want to be able to charge a premium for their product. They've given us information for both 2016 and 2017 as follows. Number of t-shirts purchased for each year, number of t-shirts discarded, so this would have been due to defect or problem with the process, and then the difference between those two is the number of t-shirts that they sold. So notice we're ignoring any sort of inventory here, we're only looking at sales. Then they tell us the average selling price for each year, the average cost per t-shirt for each year, the administrative capacity. This is the number of customers that they could handle. They have the capacity to deal with, to sell to. These are their administrative costs, and then the administrative cost per customer, which is just the total administrative cost divided by the capacity. All right, in the first requirement, all they're wanting us to do is to calculate the operating income for the 2 years and then find the change. So this is pretty straightforward. Your sales for each year are going to be the number of t-shirts sold times the average selling price. The cost of goods sold for each year will be the number of t-shirts purchased times the average cost per t-shirt. Notice that they are folding the defective costs into cost of goods sold. Gross profit is the difference between those two. Administrative costs were given to us. And then, of course, operating income is just the difference between gross profit and administrative costs. So we come down to operating income for both 2016 and 2017, and then we see that there is an increase in operating income of $1,054,750. Okay, so requirement 2 then wants us to calculate these various components we talked about in order to identify how much contributed from each to the change in operating income. Let's first look at the growth component, which consists of a revenue effect and a cost effect. So in other words, how much did our change in operating income occur because we sold more units or because we used more or less input in the production of the units we sold. So let's look at the revenue effect first. We can see that we sold 225,000 units in 2017, 200,000 in 2016, an increase of 25,000 units at the sales price in 2016. So in other words, our revenue effect is the increase in units sold or the change in units sold at the 2016 price. What we find is we have a favorable revenue effect of $750,000. So we can say our operating income increased by $750,000 strictly because we sold 25,000 more units. Now, The cost effect, we need to look at the direct materials that we used. And so we know that we purchased 215,000 t-shirts in 2016 in order to be able to sell 200,000 in 2016. That gives us basically a ratio of of 1.08 t-shirts per t-shirt sold. So what we need to do is determine how that compares if we had sold the amount of units that we sold in 2017. So in other words, in 2017, we sold 225,000 t-shirts at a ratio of 1.08. We would have needed to have purchased 241,875 t-shirts. Now, what we actually purchased in 2016 were 215,000 t-shirts. That means that at that ratio, to meet the sales in 2017, we would have had to have purchased 26,875 more in direct materials than we purchased in 2016. At a cost of $15 per t-shirt, that would have been an increase of $403,125. So that would have been an unfavorable effect of growth. So in other words, we would have needed to purchase more t-shirts to the tune of $403,125. So we have a favorable revenue effect, an unfavorable cost effect. Keep in mind, we sold more units in 2017. It stands to reason we would have an unfavorable cost effect of growth. Now, conversion costs or administrative costs are not affected. There's no impact on the cost recovery, and that is because we have more than enough capacity in 2016 to cover the number of customers we had in 2017. So we would not have had to make any change to our administrative capacity. Now, what this means is that we have a $750,000 favorable revenue effect offset by a $403,125 unfavorable cost effect. And so our change in operating income that is due to growth is going to be favorable to the tune of $346,875. So that is the amount of the increase in operating income that arose because of the fact that we sold more units. There was an increase in output, and there was also an increase of input. I am actually going to stop this video at this point. I'm going to create another video that will describe the price recovery and productivity component. That's mainly because I'm using Screencast-O-Matic for these videos and I'm limited to 15 minutes. I would rather stop here than try to rush through the other.